everyone thinks that gold is too risky because, oh, it's up at these levels, Yeah, it keeps on going. And this is even as the central banks continue, and the big money continue to hoard it as a tier one asset. When the guys running the printing presses are the biggest buyers, this isn't speculation anymore. I've been saying this forever. These are the central banks. It's a signal. And when the smartest institutional money here in the United States flips from sellers, we've been net exporters, to buyers, we are net importers, you better be paying attention. A reset is coming. Bottom line, do not trust the government data to guide your moves in precious metals. Their incentive is to mislead, not protect you. I've been saying that forever. Misdirection.
Gold and silver are entering a moment that could redefine the financial system. Central banks are hoarding gold, silver supplies are tightening, and lease rates in London have exploded to record highs. Meanwhile, the mainstream media keeps looking the other way. Andy Schectman says the London Bullion Market Association is on the verge of blowing up. And when it does, we could see a parabolic move in both gold and silver. In this video, we'll break down why the cracks are forming, what it means for investors, and how a once-in-a-generation setup is quietly unfolding right now.
Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So, in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, you know, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress, this is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know. I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a...
Let's begin with gold. Many critics say gold is too risky at these prices, but central banks clearly don't agree. They've been net buyers, treating gold as a Tier 1 reserve asset. When the institutions that print money are the biggest accumulators, it's no longer speculation, it's strategy. Goldman Sachs recently forecast that gold could hit $4,000 per ounce by mid-2026, driven by structural demand and the likelihood of Fed rate cuts. Every 100 tons purchased by conviction buyers like central banks has historically pushed prices 1.7% higher. And right now, those conviction buyers are stepping in everywhere. But silver is where the story becomes explosive. In London, lease rates, the cost to borrow silver, have jumped to 5 to 6%, compared to the normal approximately 1%. That's a flashing red warning sign that shorts are scrambling for supply. At the same time, deliveries are surging. Since late August, over 58 million ounces have been delivered, with more than 11,000 tons year-to-date. Physical silver is leaving the system, shrinking liquidity, and stressing a market already built on fragile foundations. Here's the mismatch. The LBMA trades about 600 million ounces daily, but the true free float available for delivery is just 140 million ounces, much of which is already locked up. Yet there are 1 to 2 billion ounces of paper claims outstanding. If even a fraction of holders demand delivery, London won't have the metal. Schectman believes this imbalance could trigger a default, sending shockwaves through the system. Meanwhile, the U.S. has been pulling metal back from London into COMEX vaults, putting American banks on firmer ground while European bullion banks face existential risk. Schectman argues this is the setup for a chain reaction, where defaults in London collide with massive delivery demands in the U.S. Silver's role as a Giffen good makes it even more dangerous. As prices rise, demand actually increases, from both industrial buyers like Tesla and from investors. Add in the fact that silver was just placed on the U.S. government's strategic minerals list, and you have industrial stockpiling colliding with investor demand. Technically, silver's chart shows a 45-year cup and handle pattern, one of the strongest continuation signals in market history. With a rim at approximately $50 and a base under $5, the depth measures approximately $46. Breakout rules suggest once silver clears $50, targets of $90 to $100 come into play. Combine that with real supply shortages and soaring demand, and triple-digit silver looks not only possible but increasingly likely. Gold's performance tells the same story. Over the last 6 months, gold has risen nearly 40%, compared to just 9% for the S&P 500, even during the much-hyped AI boom. Insiders are dumping equities at a 7-to-1 ratio while the public goes all in on margin and options. Where's that money flowing? Schectman believes it's going into gold and silver, quietly, steadily, and in record size. To sum up Andy Schectman's direct message, don't trust government data. Their job is misdirection. Own physical metals, not paper claims. Recognize that the LBMA system is fragile and defaults are possible. Be ready, because once the system breaks, the move will be violent.
Long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released, kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%. When compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%. The S&P is 67%. That's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month, we are seeing huge deliveries into COMEX. And why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market, not just all in, greater than at any time in history. In fact, Not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash, and they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I?
So here's the question. Do you think the LBMA can keep this fragile system standing? Or are we already witnessing the first cracks of a default? Will silver finally smash through $50, setting up a run to $90 or even $100? And will gold prove the ultimate winner, rising toward $4,500 as central banks, institutions, and now even governments pile in? What's clear is this: history doesn't repeat, but it rhymes. In 1980 and again in 2011, silver touched $50 before collapsing back under the weight of paper suppression. But this time is different. The supply isn't there, the industrial demand is bigger than ever, and the financial system is far more leveraged. Schectman is warning that once the lid blows, the move won't just be sharp, it could be parabolic. Think about it. Central banks, the very people who print money, are hoarding gold at record levels. Industrial giants like Tesla are stockpiling silver, and insiders on Wall Street are exiting equities while the public goes all in on stocks, margin, and options at the most overvalued levels in history. The writing is on the wall, but very few are reading it. So let me ask you, are you prepared for what comes next? If tomorrow morning headlines screamed that silver had broken through $50 and was racing toward $100, would you be positioned, or would you be left watching from the sidelines? Drop your honest thoughts below. Do you believe this setup leads to a once-in-a-generation rally, or do you think the system bends but doesn't break? If you found value in this breakdown, smash that like button, hit subscribe, and ring the bell so you never miss a single update. This channel is where you'll hear the truth first, long before mainstream media catches on. And remember, the reset won't announce itself. It will just arrive. The question is, will you be ready?